The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers, certified financial planner practitioner from Akers Financial Group. And here with me today is Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. Mark's been in the financial service industries for over 20-some years, and he's been featured in Investment Business Daily and quoted in the Wall Street Journal. Good morning, Mark.
Morning, Brian. Happy to be here.
I'm glad to have you on our show. Now, Mark, you and I have been working together for a number of years, and I've enjoyed our relationship because you really, truly are an expert in your field, and I look forward to our show today.
So do I. And when you mentioned I've been in the business over 20 years, while that's true, and so I went through the tech boom and bust in the late 90s and then the global financial crisis. And then, of course, you stick around long enough and you're liable to see something you've never seen before. And definitely 2020, 2021 with the pandemic and then the bounce back from the pandemic, definitely unique times and always interesting times in the markets.
Absolutely. So Mark and I have gotten together and put a show together for you. We're going to call it 22 and You. It's a market overview about 21, and then we're going to really talk a lot about 22. So 22 and You, how it's going to help you, what's going to happen during the show is try to give you some answers and some planning ideas that you need to think about with your investments. All right, Mark, so my first question to you is this. Tell us a little about 2021. What happened?
So this is a great question, and investors sometimes draw a line and say 2022 or the following year doesn't have anything to do with the previous year before that. But we're in a very unique environment in the sense that you really have to understand where we've come from to see what lies ahead of us. So, for example, going all the way back to early 2020, of course, you have the pandemic shutdown, and the market's going a very sharp and turmoil period, a sharp decline, and then the Federal Reserve, and which is the central bank of the U.S., came out very aggressively with monetary policy, and then, of course, Congress and the Treasury came out simultaneously with very aggressive fiscal stimulus. So you had this very big push of money coming into the market to stabilize conditions and turn markets around. And really the goal of policy at that time was to get us through that pandemic period. And so that was really what took place in early 2020. And then that money that came into the market to help stabilize the economy and the markets really helped stocks really go in a rally mode throughout the remainder of the year, recovering the losses from the first part of the year. And then 2021 really was an extension of that rally. So it continued to go. There was still money supporting asset prices. And for those that don't know, we do a lot of study with monetary policy looking at, are they accommodative or restrictive? And the reason we do that is because that really drives asset prices. So if they're restrictive, you can think that asset prices or equities might have some challenges. If they're accommodative, that's usually a very good time for equity prices. And that's just what we saw. And so year two was really a continuation of that theme. And so we thought we'd see a broadening out of the rally, and that's what happened. So, for example, growth stocks, tech stocks, had been doing very well in 2020. And then when we got into 2021, value stocks, traditional value stocks started to make a comeback as well and hold up pretty well. The one interesting area of the market that continues today is what's going to happen with interest rates. And last year, 2021, we saw interest rates rise, but not that much. The 10-year Treasury which is a benchmark and a key interest rate, went up to only about 1.5%, whereas it really came into the year very low, and that was because interest rates were low because we were in kind of a financial stress period. So that's what happens. Interest rates go very low. And that's going to be a big question for 2022, understanding where we've been and how low interest rates have been and what's happening with inflation, where in 2021, the big challenge was inflation started to rise, and the term transitory was used by the Federal Reserve to say, well, this is just transitory. It's a short-term kind of bump in inflation with the reopening, which is a one-time event. But inflation has seemed to be stickier than policymakers would prefer it to be. So 2021 was really a year about inflation finally breaking out from this 2% trend that it's been on for the last 20 years.
Yeah, there's been a lot going on in 2021. I guess at the end of 2020, the vaccine that was available sort of broadened the market out and allowed dividend stocks and some other companies to really start to come back. And so the 2020 hot stocks, sort of the COVID stocks, sort of slowed down in 2021, right?
Yeah, definitely. So there was some very hot and aggressive tech or disruptive innovation stocks that got the market's attention. Part of this would have to do with any time that the Fed or the fiscal stimulus comes in, you're going to have these pockets of speculation creep out. That happens anytime that monetary conditions are very accommodative, and that's what happened. And so you saw money start to rush into some of these really long-term growth stories that may not have had earnings, which are still good companies. I mean, even in the internet age, for those that might go back to that time period, there's a number of companies that didn't make it, but also during that period, kind of the exuberance around that area proved to be correct. It was just a little bit early and prices got ahead of themselves. And then they went into a big correction. But now today, of course, they're some of the largest companies in the world. So we do think some of those companies are going to do very, very well over this decade. But you're exactly correct. Some of the more traditional dividend paying companies really started to do better. The value stocks started to do better, where some of those really high growth tech stocks really started to come back down to earth, if you will, and enter a correction.
Yeah, so in 2021, I guess when people look at their portfolios, it's really about how diversified they were would dictate how well they did. Now, some people are extremely aggressive, and I guess there's the meme stocks, there's the FANG stocks, which probably didn't do as well in 2021, and then there's crypto. So those are three topics I have for you about the story of them in 2021.
Sure. So with meme stocks, those are stocks that kind of caught on some of the chat rooms for some of the younger folks that may want to speculate on. And then on to, if you look at crypto is starting to become, it's an emerging asset class in our view. It's very early on. It's very volatile. There's some very grand thoughts about what it is, what it could be, but we're at the very early stages of this, and Bitcoin being the largest. So we monitor that market and what's happening in that market. And that was also the first cryptocurrency. They're all different cryptocurrencies with different use cases, but I would mention that they're not, it's a very early on, and we expect high volatility in that space for years to come. And then you mentioned diversification, and I should have added this when we were talking about 2021 and kind of the opening, which is, bonds with interest rates rising, bond prices decline. So some of your conservative portion of your portfolio actually could have declined last year in what, commentators think is a good year for stocks. But, when you're a diversified investor, which all investors really are, when you get to individual investing, you want to have a conservative piece of the portfolio. But sometimes if interest rates are rising, for example, in your bond portfolio, you could see prices decline. Now, they didn't decline very much, but that's just part of investing and part of the challenges of investing and how you allocate that portfolio.
Yeah, the interest rate tried to creep up a couple of times in 2021, and then you could see the bond pricing start to lose value, and then it really settled right back down. And so here in the review of 2021, where did the Treasury end up the year?
So it was up, the interest rate, the 10-year Treasury interest rate was about 1.5%. So not high by any means, still very low overall. And in fact, it's been over 10 years that the 10-year Treasury has been below 4%. For the previous, basically, 40 years, it had not gone below 4%. And most traditional professionals in the industry thought it could never go down below 4%, meaning they thought there was a problem in the market and rates were going to spike. And lo and behold, they've dropped even lower. And this is part of, I think, one of the biggest challenges for investors is this low interest rate environment. How do you build a portfolio conscious with risk management with these low interest rates? And the challenge now is that, those interest rates are below the rate of inflation, and you could be losing purchasing power over time. And that's one of those things that slowly creep up on you. So this is a big, big challenge. And it doesn't get talked about a lot because bonds aren't really, don't have an entire TV channel like CNBC or one of those channels talking about prices because they're a little bit more complex. But for pre-retirees and retirees, they're a very important portion of the portfolio. What do you do to generate income? What do you do to reduce risk in your overall portfolio?
Yeah, this is extremely important, as last year on 2021 became the year of I need to retire now. And so the amount of people retiring increased. And so you have the portfolio volatility, you have all the talk of what's going on in the markets, the interest rates. There's so many things to talk about. And then there's people wanting to retire into that kind of ordeal. Now, generally speaking of 2021, what was your overview? Like, was it a good year, a bad year? What's your opinion of that?
I thought, once again, it reiterated the benefits to being a disciplined investor, understanding that you are an investor and you're thoughtfully allocating your portfolio, not for one economic environment or one event, because there's always going to be events. Every year there's an event that something kind of happens in the markets or the economy. But if you're disciplined and you stick with your strategy and you thoughtfully make adjustments from time to time, rebalance, all those typical or sound time-tested principles really worked, because you couldn't just listen to the news and make decisions. You had to really, over the last couple of years for sure, you really had to have a plan and then execute that plan in the face of uncertainty. And I know you deal with this all the time, Brian, making sure that clients have a plan and an investment approach that makes sense for them.
Exactly right. Even this show, Winning in Retirement, is designed around you, the client, you, the person listening to the show, about what to do in your finances when it comes to all situations. So the show today is called 22 and You. And at Akers Financial Group, we want retirement to be where the biggest worry of your day should be where you're going to drink your morning cup of coffee, where every day seems like a Saturday free of stress. Your retirement income and investments are taken care of by the team of advisors at Akers Financial Group. If this is the future you want, it's not too late. Go ahead and give us a call at Akers Financial Group for a free meeting. Give us a call at 833-WIN-RETIRE. That's 833-WINRETIRE. When you call, leave us a voice message, and we'll call you back on Monday to schedule a phone meeting, a virtual Zoom meeting, or an in-person meeting with one of our team of advisors. Start planning for your retirement now. Give us a call at 833-946-7384 or go to our website at akersfinancialgroup.com. Will interest rates rise throughout 22? We'll talk about that in the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
The announcer just welcomed you back, and I'm here to welcome you back to Winning in Retirement. I'm Brian Akers, Certified Financial Planner Practitioner from Akers Financial Group. And here with me today is Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. He's been in the industry over 20 years. Brookstone Capital Management is a third-party money manager for our clients at Akers Financial Group through our RIA Kalis Management. So what we do is we use Brookstone Capital Management to help manage the money of our clients, help that money be managed throughout their lifetime. This show today is called 22 and You. It's a market overview about last year, but we're really getting into 22 and how it might affect you based on different topics, different things that we're thinking about that might happen during the year 22. And we're going to give you some strategies to think about how to invest your money as we go forward. We love working with Mark. We love the ideas that he gives us. We like the fact that he's a steady hand. He's not going to be a whimsical. He's not going to be telling you some crazy ideas or crazy thoughts. He's going to give you the facts and keep it simple, but he'll also give us the right direction we need to think. All right, Mark, you ready to go here in the second quarter?
Let's do it, Brian.
All right, I got this question for you. Will interest rates rise throughout 2022?
This is a more complex question than I think most investors realize. There is something called the time to maturity. So it's just the time, just like you're investing in anything, how long do you hold, or when is the bond mature? Is it 1 year? Is it 5 years? Is it 10 years? And so last segment I mentioned kind of the marquee interest rate that the markets key off of is the 10-year treasury rate. And last year it ended at about 1.5%. Already to start the year, it's up to 1.75%. So it has risen, and it's really rising in response to inflation. And inflation has continued to run hot, much above the 2.5% where the Fed really targets or is comfortable with. So that's kind of been a sticking point to how high inflation goes. Historically, those long-term interest rates are based on kind of economic growth and an inflation rate over time built in. And so it's really odd that the long-term interest rates are actually at that low level given where inflation is. So that's causing a bit of a conundrum. Now, on the short duration side, less than 1 year, the Federal Reserve controls what's called the overnight or the Fed funds rate. So when you hear them raising or decreasing interest rates, that's really short-term interest rates, and then the long-term kind of respond to that. It is currently priced in about 80% by the markets that there will be 4 interest rate increases by the Federal Reserve this year. That would make it up to 1%, so quarter of a point, a quarter of a percent increases. That seems awfully high to me, and that would be very aggressive interest rate increases in today's world. We think rates are going to stay low for longer for a variety of reasons. One of them you touched on actually last segment, Brian, which was interesting, which is how many folks retired last year, kind of this pandemic and post-pandemic phase that has actually caused a lot of retirements. People think the jobs market is really due to, let's say, younger folks not going into the job market or having unique or different demands. And while that's somewhat true, the big change in the labor force is that more retirements have occurred, which is actually pushing up the savings rate and keeping interest rates low. It's a very interesting dynamic that's happened. But the point is, short-term rates are probably going to head higher. But when they head higher, it's actually going to slow down the economy and inflation. And longer-term rates, and this is where we're definitely a contrarian relative really to the rest of the industry, I think, a very low percentage of the folks. And this is where we want to be a contrarian because that's where the opportunities come from. But anyway, we actually think longer-term rates after this brief moment of heading higher is actually going to reverse and may head lower here because they'll be fearing that the economy and inflation is going to slow much quicker than expected. And so I think you have, that's why I say it's a more difficult question or complex question, which is short-term rates can rise, longer-term rates can fall, and that can happen simultaneously. And that's one of the challenges with especially with the retirees saying, well, how do you manage your bond portfolio and what adjustments do you make and what alternatives are there to build that conservative side of the portfolio and generate income?
Yeah. When I was thinking about all that, I was thinking about that word you used in the first quarter, transitory. And we're talking about inflation coming and then going. Is that what you're implying by saying interest rates long-term might go down?
Correct. So there's parts of the market that are transitory, and that was probably a big word of 2021. Is it transitory? And then what is the definition of transitory? Yeah. Everything, in a sense, is transitory. But is it transitory multiple years? Transitory usually would mean it's 3 to 6 months kind of coming into the marketplace, kind of this anomaly. And so what was driving up inflation last year strongly was these supply disruptions, and they just haven't quite been solved. However, we think that they will get solved here as we look through 2022. And what 2021 saw and the end of 2020 was this big pull forward in demand, meaning coming out of the pandemic, with the lockdowns and all these different disruptions, that demand actually came back online very strong and very aggressive, but it pulled forward demand that we're not going to see later in 2022. And so any supply disruptions will actually get ironed out. And now, granted, there will be some pockets in some areas where there is kind of a mismatch of demand and supply. And so you would have a little bit longer term for inflation to stick around, but many other areas will get solved and that inflation component will drop. But the other part of that is we expect economic growth to definitely slow down from how hot it was running last year.
Okay. What drives Fed policy when you see things the way they are right now?
So what really made them pivot was a pivot to be more what they call hawkish, meaning now we're going to be more concerned about inflation and trying to cool off inflation. Now, for 40 years, the Fed really had a policy of trying to contain inflation, and this was a leftover from the 70s, which was really the driving force of saying, look, we wanted to slow down inflation and have that continue to decline and decline. And really, we've got to a point right after the global financial crisis where they said, well, wait a minute, now we need to get inflation kind of going again, because that'll inflate the debt away, that'll help wages increase. But it's been awfully difficult, and it stayed below 2% for the better part of the decade or so post the global financial crisis, 08 and into early 09. And they've adjusted just recently to something they called average inflation targeting, meaning they wanted to allow inflation to run higher than 2% for an extended period of time to kind of average that out. However, we've just got this acute. Now that was before really the pandemic hit, and then the acute challenge that posed. The problem is today is that inflation is getting it to a level and kind of been sticky, that it's actually hurt consumer sentiment and discouraged it because prices were much higher now, whether it's housing, autos, or just everyday items. And so that's really driving the Federal Reserve's decision right now to raise interest rates to get inflation under control, to back in line. Our position would be there's only so much they can do to solve what we thought was a supply disruption issue. And once that goes down, I think, and we already see it turning in some of the data, once that goes down, I think we'll be back more in equilibrium and inflation will be down, which may cause the Fed to not end up being not as aggressive with their interest rate increases.
Is it possible that the Fed just wants to make noise so that you had mentioned that 80% of the four rates are sort of already priced in? So making noise has already created the same effect as raising a rate?
I do. I think they would be happy if they could talk the market into calming down, cooling off, kind of resetting expectations without having to raise these interest rates, because it reminds me a little bit of the end of 2018, where the Fed kept raising interest rates, and finally the market said no more, and you had this really sharp correction in the stock market, almost 20%. It was about down 18%. It was down sharply in December. Well, the Federal Reserve pivoted, and within about 6 months into 2019, had already started to reduce interest rates because they just went too far. We think it's kind of like that. So I don't think they actually want to raise the rates that aggressively, and would prefer to go slowly, especially if the markets kind of respect that move. They already adjust. There's already some turbulence in the market. And then the supply disruption kind of starts to ease.
I wonder if this will help people that have their money sitting in a savings or a bank account.
Not much. And this is, sometimes people ask, who's paying for all the kind of the leftover from the global financial crisis and maybe some of the debt spending and the government assumption of debt? And it's pretty simple. It's the folks sitting in savings accounts or CDs thinking that they're getting interest, and interest they're going to get, right before the global financial crisis, you could get 4 to 5% easily on a CD. And so you're making money and so forth. And that hasn't been the case in 10 years. You've been earning less than the rate of inflation. And although it's not volatility, which spooks people, it's the other bigger issue and the reason to invest, which is, well, inflation's going to eat away at your purchasing power. And before too long, it's going to really substantially affect your purchasing power. And that's just what's happened over the last 10 years. And that's somewhat set to continue.
Absolutely. And that really ties right into our topic for the second half. Now, as we end here in the second quarter, what I want to remind you is that Akers Financial Group, we're local, we're independent, and we don't report to a big company on Wall Street. We report to you, the client. We have offices in Forest Hill and Lutherville, but work with clients all around the country. This is all about you and not us. It's about your retirement. To begin winning in retirement, give us a call at Akers Financial Group to schedule a free meeting to sit down with one of our team of advisors and talk about your exact situation. Give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and someone will call you to set up a virtual Zoom or an in-person meeting with one of our team of advisors. Start planning for your retirement now by giving us a call at 833-946-7384 or go to our website at akersfinancialgroup.com. What are your opportunities in 2022? We'll talk about this in the third quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
I'm Brian Akers, Certified Financial Planner, Practitioner from Akers Financial Group, and welcome back to Winning in Retirement. Here with me today is Mark DiOrio, Chief Investment Officer of Brookstone Capital Management. I've been in this industry over 20-some years. Brookstone Capital Management is one of the third-party money managers for Akers Financial Group, and we welcome him to our show like we do about 2 or 3 times a year. Now, Mark and I designed this show today. The show is called 22 and You, the market overview. 22 and You, it really applies to what you need to do with your personal finances. Now, we love creating financial plans for people. Mark loves investing and building allocations and building a core portfolios and satellite portfolios for our clients. So when we put together this show today, we want to talk about the markets, and then we want to tie in to opportunities and strategies that clients need to look at and think about as we talk about 2022. All right, Mark, we're entering the second half of the show. Are you doing okay?
Definitely. Now's the time.
Well, I figure both of us are coming off a football season, being a Bears fan and us being Ravens fans. So sometimes when we talk second half, we have some bad memories probably.
Definitely.
Yes, but we're going to move on to opportunities in 22. So, Mark, what are your thoughts about some opportunities in 2022?
Sure. One of the things with financial markets and financial challenges, and a lot of times we'll talk about volatility and trying to explain what's happening in the market. And it might get lost on investors that every year there's also opportunity. So a challenge also brings about an opportunity or opportunities. And one of those areas would be, and what we're seeing already as we look off and as 22 has gotten started, is a very classical strategy that's very effective for retirees, which is looking at a dividend-based portfolio or a dividend allocation. So dividends are distributed from companies and stocks directly to their shareholders. So it's not determined by the market prices or the whims of Wall Street. Really, it's determined by how well the company is executing, and then they share a percent of the profits with their investors. And what's interesting is this is different than traditional tech stocks, which may be a little bit more volatile. These are solid companies, and they go in and out of favor like any type of sector does. Or any type of style does, but it looks like they're coming back into favor this year from a price perspective, but they really never go out of favor in terms of their effectiveness in distributing income or dividends to investors. And why it's also interesting is that in today's world, you're getting dividends at a rate that is higher than you're getting on bonds. So right away, you start with a higher income coming from your equities, plus you have the potential for price appreciation from those equities. So that's a really interesting area we think is coming back into favor right here.
Yeah, one of the thoughts I've had is that when we're upset with the interest rate they pay in the bank, why not just own the bank stock, and the bank dividend will pay you a lot more than having your money actually in the bank?
Yeah, definitely. And now you have some price appreciation potential. So it's a lot different environment for banks today, in addition, just pivot, kind of expanding on that thought, than it was going into the financial crisis. They're cashed up, as we would say, meaning previously going into the global financial crisis, they were highly levered to markets and loans. Today, that's not the case at all. It's been over a decade from that, and they've kind of been in that cleanup phase. But as you mentioned, yeah, the dividends coming out of there are actually pretty attractive for investors.
Yeah, so market volatility is going to be heightened in 22, would you say?
Definitely. With all the changes in the Federal Reserve looking to change interest rate policy, that changes the investing backdrop. And so, I would say that will lead it to kind of financial markets finding their footing, shifting from favoring one area to another area. So this, we think, and the questions around inflation and interest rates, we think will cause a lot more volatility than we've seen, and particularly saw last year in 2021, which was not a very volatile year at all. The average correction in any given year for the stock market is 14%. So we didn't have that last year. We had very little movement, did not have a double-digit type correction. I think that's a good base case scenario to develop throughout the year at some point. And as I was mentioning, that's not necessarily something to run away and stick your head in the sand. That's actually where a lot of opportunities start to pop up. Some areas of the market get oversold, and you can look at an opportunity to reinvest or reallocate some monies into those areas that are good long-term plays, because we don't think it's, you're not down and out. The markets historically do ultimately come back, but we also think there's that would tell us that, all right, it's a more volatile year, so maybe we want to add some components that, even if we think stocks can outperform bonds, we want stock exposure without as much risk or volatility as the market. So we look at something called hedged equity as being very effective. That it's beyond maybe the scope of the conversation of what comprises that allocation. But in simple terms, it's you own an equity allocation, and part of that allocation actually you use as a hedge or a buffer that helps mitigate the downside. And so there's a number of strategies. We're actually expanding our suite of offerings in this area, and have spent a lot of time researching this area. And it's been very popular with investors, I would say, because they realize that, okay, we don't have to worry about bonds, but we can use the hedging approach to reduce risk in the overall portfolio, and we get equity directional type of performance.
Right. So in hedge, typically you don't get all the market on the upside because you're spending money to be hedged?
Correct. So that's kind of the cost. So you think of it as a certain percent or a cap on the upside. Is it reasonable? Is it a reasonable level? And that's what really our job is, to say, okay, here's how much it's hedging. So one of the suites has 3 different series to them. And it would say, okay, we buffer the first 9% of the downside. So it hedges 9% of the risk of the downside of the market. So if the market's down 20, you're only down 11, for example. Now, another series of buffers are hedges 15%, and another hedges between -5 and -30%. And I know that's a lot there, and I'm not expecting everyone to realize it, but it's just telling you that you have different downsides. Now, the exchange for that is the more downside that you're protected from, the upside lowers a little bit because it's pain, or that's the cost of that hedge, which is very normal. That's how those markets work, or how hedging works overall. But when we look at it, those upside caps, which do change from month to month, are very reasonable.
So my brain starts to think hedge on, hedge off. And is with the volatility that you see coming on, is this the concept of the opportunities might be to have a hedge on?
Yeah, I think it allow you to ride out the storm, if you will. And the storm might be too strong. I mean, these are markets. Markets are volatile. They do move up and down. It's not always predictive. When they're moving down, that doesn't mean they're going, to zero, it really means that, okay, there's volatility and uncertainty in the marketplace, but then storm clouds kind of pass and all of a sudden you have clear skies ahead. And so one of the ways, though, to manage that and to reduce your risk overall, though, so if you don't want to be as volatile with your portfolio, is to use some type of hedging in there, a hedged strategy that can offset some of that risk and reduce just kind of how much your portfolio swings. So we definitely see it, as I was mentioning, clients actually in that pre-retiree camp appreciate that allocation because they realize that they are still participating, but just at a lesser intensity.
All right. So the opportunities you covered in this quarter here has been about dividend and portfolios going back to some of the basics of investing and then adding a hedge. Is there some other opportunities for 2022 that we need to think about?
Yeah, at some point, and you actually mentioned this, and I didn't mention, kind of respond as well to it on the FANG stocks, the typical tech stocks that Facebook, Amazon, Apple, Netflix, Google, Microsoft even. A lot of those big stocks that were large percentages of the traditional indexes, those have actually started to, as a group, don't look nearly as overbought as they did. So if we do see a type of a sell-off, they may actually look pretty attractive. So classical tech stocks so that's classic tech stocks as a group might be interesting. So you wouldn't give up on those, let's say. So that's something we'd look for in a correction as an opportunity. The other thing, which we don't talk too much about, is energy. We think even though there's a move towards sustainable, there is still a need for oil and energy and so forth. And they've just been really sold off by the marketplace, and we've seen those been rallying. So that's an area as a unique kind of opportunity. And the other one, which has not been in favor for a number of years, is international markets. The U.S. has outperformed most developed markets and the emerging markets over the last several years, but history shows that ebbs and flows. And one of the reasons why international markets lagged last year, especially relative to the U.S., is because China actually was had a very restrictive monetary policy last year. They were the first ones to go into the kind of the pandemic-induced recession and the first ones out. And then they were the first ones to really be restrictive to make sure that inflation and speculation didn't get out of hand. Now they're in the opposite position. So those stocks have really been hit hard. That economy's been hit pretty hard. And we think that their policy is now easing, the exact opposite of where ours is tightening. Theirs is starting to ease. So that would help international markets, for example, in a relative sense. So we wouldn't throw those out. We think there's still a definite diversifier to a portfolio and may actually have at some point here turn and take some leadership role.
Yeah, those are some good ideas for opportunities for 2022. I'm glad we didn't give them all out. We just gave a few of them out. So as we end here in the third quarter, I just want to remind everyone about retirement. Think about retirement. You have that dream about retirement. The best part of retirement is getting your time back. You decide how to use your own time. Before retirement, the time is tied up with other commitments, mainly your job. A lot of that goes away at retirement. Your time is now consumed by things that you want to do. To begin winning in retirement, go ahead and give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and one of our team members will give you a call back on Monday to set up a phone meeting, a Zoom meeting, an in-person with one of our team of advisors to talk about your situation. Start planning for your retirement now by calling 833-946-7384 or go visit our website at akersfinancialgroup.com. What might this cycle of inflation look like? We'll explain in the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I am Brian Akers, Certified Financial Planner, President, and I'm founder of Akers Financial Group. Here with me today is Mark DiOrio, our Chief Investment Officer from Brookstone Capital Management. And what we've been doing today is talking about a show called 22 and You. 2022 market overview, and talking about how this can be something that you take as an opportunity rather than a challenge, or you actually look at your investments and think about what should I be doing next? What should be the way I design my portfolio and plan for the future rather than react or have to react at the wrong times. So this show, as we've been putting through the first, second, and third quarter, we talked about 2021 in the first quarter. We talked about interest rates in the second quarter, opportunities in the third quarter. If you'd like to hear this show again, go to our website, akersfinancialgroup.com. Akers is spelled A-K-E-R-S, financialgroup.com. On that website, you'll see information about our company. You'll see a tab on how you can actually go through our website and contact us and schedule that first meeting. You can also see tabs up top that say radio and webinar. Under radio, you can see this show will be up on that website. You can hear the show anytime you like after broadcast. The second thing that you can do is go to our webinar, and you can hear a market outlook put together by Akers Financial and our investment committee, our internal staff with Bernie McVeigh, myself, and Alex Monk. All right, Mark. This is Mark DiOrio. We're welcoming back. Mark DiOrio is from Brookstone Capital Management. I've been working with Brookstone Capital Management since 2013. And Mark, I wanted to thank you for the way you have helped my clients and the way you treat my clients and the way you handle the money that my clients have put aside for the rest of their life.
Oh, well, that's very kind of you, Brian. I've really enjoyed our partnership, and I know that we talk frequently with your investment committee. And I know just how much you guys care about the portfolios and think through a lot of the issues and how it relates to individual clients and achieving their goals.
Yeah, we try a total portfolio perspective in every person we talk to. We try to take a portfolio designed around their goals, their purpose, and then build the investments that they need to fit. And that's the flexibility that Brookstone Capital Management allows us to have with as a third-party money manager. We can have an account with multiple ideas all in one investment account and be able to bring that together and make changes in the future as things go around. Now, could you mention what the concept of like a core and satellite investing might be?
Sure. One of the things we're known for is building, and our portfolio allocation is really designed around, is something called a core plus satellite allocation framework. And what that means is, okay, what portion of your investments would be a core, diversified, risk-appropriate portfolio? Meaning, what are the traditional stocks, bonds? What's that mix? What asset classes go in that mix? And that usually comprises the biggest component of your overall portfolio. However, we like the satellite idea, which allows us to really customize the individual, as you were mentioning, Brian, customizing towards the individual's goals. So do you want to add a satellite holding of income generating assets that may be producing additional income on top of the traditional portfolio that's outsized, that may give you higher cash flow coming off that portfolio? Or do you want to have something that we talked about in the last segment? Do you want to have a little more risk reduction in that portfolio and some hedged equity component maybe to complement your core portfolio? Or do you want to look at some really aggressive growth ideas? And we mentioned disruptive innovation and some of these ideas of where these stocks could have some outsized gains, and is really what we call thematic investing. Here's a theme that we think is going to play out over a long-term time period. It would make sense to put those allocations in the satellite. So really what you're doing is building that risk-appropriate core portfolio, but then enhancing the opportunity set with your satellite allocations to complement your core portfolio based on your individual goal or outcome.
Yeah, to me, this makes perfect sense, but many people out there that are listening do the market timing concept of investing, where they try to get out thinking the market's too volatile now, and then they'll know exactly when to get back in. How do you explain away that kind of concept?
Sure. We really emphasize portfolio construction, and the core plus satellite design allows us to do that. And over 20 years in the business, I've seen that be more effective, time in, time out, and more consistent delivering on reaching your goals. The idea of kind of timing the market can be very challenging. And for professionals, if they get out of the market and the market rallies, for example, well, they're always waiting for it to decline, and it doesn't always decline. It could be a long time that you're waiting, and you kind of miss out on the big move, where if you put really a lot of thought into your portfolio construction and have those pieces working as expected and based on good data-driven analysis, you're going to be able to capture those returns and also be able to make it through and navigate any of those challenging, volatile periods.
Absolutely. I think about market timing, and my comment is usually the portion you want in the market. It's about time in the market, not timing the market. If you try to market timing, you got to make two perfect decisions: get out and get back in. And basically, a lot of times you'll miss the getting back in if you didn't already miss the get out part. So it makes it a lot more difficult, a lot more emotional when you're trying to guess the market and thinking that you're getting all out and get all back in. What I tell people is if you have a feeling you need to get out, that means you might need to lower your risk overall. And that means you might want to take a little bit more money off the table and build your protected side more. So as we build portfolios. Now, Mark, let me just go ahead and get into my question for this quarter, which is what might this cycle of inflation look like? We've had a pretty high inflation in 2021. What's going to happen here in 2022?
Yeah, we think it's going to sharply decline and actually surprise how quickly it's going to decline. And we think it's going to decline because supply bottlenecks and disruptions will ease. The dollar actually continues to be strong, which actually is disinflationary. And we also see less fiscal spending as well. That's going to reduce aggregate demand. So we think it's actually going to be lower than what everybody fears. So we may be peaking, as we're talking about this in early 2022 right now, in terms of some of the headline numbers, and that the longer term number in 2022 in particular is going to start to see easing of those inflationary pressures, with the caveat that it can still pop up in certain areas of the economy where there's a little bit more trouble getting supply disruptions back into alignment. But when we look at inflation, I think it's important to point out we're looking at some macro drivers that have been driving the long-term trends in overall inflation. The first one is technological innovation, which has driven down inflation for years. And we see that trend continuing. And for those that didn't use Zoom in 2019, for sure, a lot, especially in the business world, people were using things like Zoom communications, and not to point that one out, there's a number of different ones, but that one's an obvious one that Zoom came into the lexicon. And so we think that demand, for example, or that technological use was pulled forward and probably going to stay. In other words, that's going to be a more and more part of business. And so that's just a way that technology continues to be disinflationary, is what they say. Globalization and competition would be another one. That continues despite kind of these challenges with going back a couple years with kind of balancing out the trade differentials, and China was being the big one. However, globalization continues, and the more that technology gets widespread, the more countries will get involved in the expansion of that labor pool globally. But the other one is, for U.S. in particular, is demographics, and U.S. and the other developed world. But in this case, I'm referring to the U.S. Demographics are not necessarily inflationary right now, with more and more, and we hit on this earlier with kind of the move towards retirement. And seeing more retirements, that is not inflationary historically. So the demographics actually argue for low inflation for some time. And the level of debt that we have as a country would say that that's disinflationary. At some point early on, when you're assuming debt from a low level, that's inflationary. Asset prices are rising, wages are rising, but then you get over indebted, and then that is kind of a drag to growth and to inflation. And so we think those drivers are very big, where after a short-term cyclical issues such as we're having now, those big trends are going to reassert themselves.
I listen to all that and I hear about inflation. I think about those that got cost of living adjustments in their retirement years and how they see a raise, probably the biggest raise they've had since they started drawing Social Security. And then what I hear you saying is they might not get another one like that. Now, when I think about retirees, I'm thankful that inflation is might slow back down, because inflation is one of the biggest fears of the retirement years. And that's truly why people in retirement and to win in retirement need to keep a portion of their money in stocks, because the only way to beat inflation, no matter what it is to have money invested with risk.
I definitely agree with that. The reason you build a portfolio is the preservation of purchasing power over time, and then to grow that purchasing power over time as well. And so when we think about the inflation issue, although I was talking about some macro trends, that's not necessarily how you want to think about building your portfolio. Inflation will be with us and will continue. And it's kind of this slow leak that happens year over year, and then it compounds over time. And so we definitely want to take into account and remember why you're building a portfolio, because it has outpaced inflation over time. And you mentioned rightly so that equities have been the driver of that return. So even if you're looking at healthcare inflation, which is much higher than broad-based inflation, and I would say inflation is actually unique to different demographics, your age, your condition, and it's almost individualized in terms of your consumption basket, if you will. But healthcare is one of those areas that has risen much higher, and so the retirees have seen higher inflation in that area for sure, and being a bigger component. So that's actually a different number than the overall, what they call CPI, consumer price inflation number. And I'd expect that to continue in that direction. And so you definitely want your portfolio to take that into account. And you can't just go, the traditional advice in the advisory world is just sell your stocks and move into bonds as you get into retirement and be more conservative. We don't think that's a great recommendation. Even though that's the general advice in the industry, because all you're doing is selling an asset that has a history of outperforming inflation over time and moving into one that currently is yielding less than inflation. And so that you're basically locking in low rates and rates below the rate of inflation. So you're actually going to look at losing purchasing power over time.
Absolutely. Those are great final words there, Mark. Thank you very much for being on our show today. And we want to thank you for listening. Now, at Akers Financial Group, we want you to win in your retirement. Go ahead and give us a call at 833-946-7384 or go to our website at akersfinancialgroup.com. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.